So there's 7 steps that I use in order to make sure I'm investing in good deals, maximizing my profits and minimizing my risk so I can build a full-time income investing. And I'm going to give you those 7 steps, those 7 tips that I wish I had earlier so that you can get faster results investing in the stock market or any asset classes right now. Now, we're in an innovative age, and we're going to go into some of the top methods that have been proven to work, not just by me. This isn't anything necessarily new, but it's going to be the most innovative, different methods we've found over periods of time, and also in my own experience, what's worked best for me. For those of you guys that don't know who I am, my name is Will Rich. I have worked in finance before for many years in Boulder, Colorado. Been trading stocks and investing since I was about 16 years old. I have long-term portfolio as well as trading the short-term investment swings in all types of companies in AI. We're definitely in quantum computing as well as tech and data centers and space tech. And if you've ever wanted to learn how to invest in these types of companies, this is the place. Make sure to subscribe. Let's jump in. So, number one is going to be probability stacking. And probability stacking kind of looks like this. So, you have probability stacking equals this 7-step framework. It's a 7-step process. And essentially, how we do it is it looks something like this. In step number one, this comes from what is our map strategy. And map strategy is something that I've developed to streamline finding a good deal in the markets. And it's market for the M, A equals analysis, and then P equals the profit or the plan. So step number one is the market analysis. And the market analysis is going to be broken down into the profits and the revenue. And then you're going to break it down into number two, which is the usage. So if you're ever trying to identify, let's say, AI markets that are profitable, or you could look at markets that aren't profitable, these two indicators right here are going to be the main things to validate your market. So it might be that they have one of these, but they don't have both of them. So a good example would be something like NFTs. NFTs for a while had a lot of traction, a lot of people trading them, investing in them. There's a lot of money going into it. But the actual real world usage over here was minimal. It wasn't really seeing any real world impact at the time. Maybe it could in the future, but that's an example of a market that ended up collapsing because there was a lack of real world usage. You know, a good example of a market where you do see real world usage would be something like you see the profits coming in for a company, you see that they're making money, but then you also verify that they have a product that you could see in the world. Like, for example, my iPhone right here. That would be a good indication. You could look at the balance sheet of Apple, but also say, oh, I have an iPhone, or it could be the iPad. That's real world usage that you're seeing right in front of your eyes. So usually it's something that you can see, that you can feel, that you can touch, or that you can observe, and see that it's actually getting used in the world, and making sure that if there's an article or news source that you find around that usage, that it is indeed accurate, and that it's not fabricated. And most likely you want an article that's coming straight from the company, or the source of that article is going to be the company. So those are the first two steps. You want to have positive profits, positive revenue. You want to see real world usage. Now the next step is step number 3, which is going to be into the analysis stage. And the analysis stage, usually we start off here with the financials. So the financials give us an idea of things like the balance sheet. So it could be the balance sheet, how much cash they have, their assets. You want to know how much money the company's generating. Are they positive? So this would be like their EPS. This would be their PE ratio. And usually, like, if I'm looking for a good PE ratio, it's usually for value investing, usually around 20, something like that. Financials, you're looking for positive net income or at least really good revenue. And you want to see definitely assets that are greater than the liabilities. Now, if you're going to want this entire spreadsheet, I'm going to give you this entire whiteboard. You can grab it in the second link down below, and I'll give it to you for free if you want the full breakdown of this once we're done. Now, number 4, so the financials are a big piece, but number 4 is going to be, this is the 7-step process, right? Of now we're getting into the news. So this is more fundamentals. So this would be kind of like product. This would be deployments of the product, or this would be developments. This would be, let's say, manufacturing, or this would be, could be financial news, could be related to their new offers, their new products that they have going out into the marketplace, or could be related to things that would drive the stock down or make the stock go up. So kind of like good news. So something like, let's say they come out with a new product and it's innovative. Good example would be, when APLD, which is a data center company, said that they got a $7 billion deal with another AI company. That's like good news. Bad news might be that, we could see that a company lost a deal, or they, for example, their product gets pulled off the shelves, or like a good example would be like an exploding, car or something. It's like, oh, or exploding, when Samsung exploded, or somebody does an article or a speech and they say something that would not be good for the stock. Like a good example is like Cristiano Ronaldo he was at a conference and he had a Coca-Cola bottle, and he pushed it off the table and put his water on the table, and Coca-Cola lost like $4 billion in revenue as a result of that move. So things like that. And then the 5th piece is in the analysis stage here. So we're kind of, I'll just mark it out. We're in the analysis. We started with the market. Now we're in the analysis. And the 3rd piece of the analysis, number 5 in the 7-step process, is going to be the charts. So in the charts, we like to really use the trend. So we're talking about support and resistance. We're talking about the RSI and the MACD, so giving us an idea of oversold versus overbought. We really like to use, for example, the EMA, so the exponential moving average, or the 200-day, the simple moving average. We oftentimes we'll even use the Fibonacci sequence as well to get an idea of where the stock is at. And so the charts, a lot of that is support and resistance. So kind of getting an idea of, if it's near a bottom, if it's near a top. You're going to want to look at if it's an overall uptrend. Is it on the lower side of that trend, or is it on the higher side of that trend? Is it overbought or oversold? And in the charts, we oftentimes use those tools. Now, getting into number 6, and this is one of the keys in probability stacking, and that's going to be that you get into the profit, and really I like to start with the risk. So the risk here, now we're getting into the plan basically. So the risk, we're definitely looking for risk that is going to be like somewhere between 1 to 5. So for example, like if we're going for, let's say, 20% margin for profits. So we're going for a 20% margin. And that's where we would sell. Somewhere up here, we're looking for a buy and sell. And we enter down here, let's say This is the entry. Then, and this is the profit, the sell for the profit there, up around 20%. So we would do a stop loss that would be negative. In this case, it would be 4%. And so if we were going for, let's say, 10% here for profit, 10%, then we would set a stop at 2%. And it's just proportional. That's how we do it. And there's actually a profit calculator. If you want to grab it, it's in the third link in the description down below. And it's a free profit calculator that adjusts proportionally and actually gives you whatever the margin for profit you're going for. It will tell you where to set your stop and even the price point at which you would set it when you give the information of the trade you're going into. So that's the risk, kind of the risk to reward. And then the profit, oftentimes when we're going for profit in the plan, we want all these things to kind of line up first. We're looking at the financials, we're looking at the news, we're looking at the charts, we want the markets. Even in a short-term trade, we invest in companies and trade companies that we're already looking at from a intrinsically valuable perspective in the long term. And so the profit really is going to match, something that would be, if we're risking, negative 2%, again, we're going to go for, plus 10% and what have you. So we're always looking for at least 10% to ideally looking for even up to 50% opportunities. So I'm really looking 10 to 50% opportunities in the markets. So those are kind of the markets. Because what happens is, let's say you do a 5% margin for profit. You're going for 5%. Well, now your stop loss is going to be just negative 1%. So what does that mean? Well, it means there's a pretty high chance, a pretty high probability that this negative 1% stop loss gets hit. So basically, the further out you go, the more margin for error, or the less margin there is for error. So like if I'm, the further out I go, the more wrong I could be, basically. Because, if I'm going for a 50% margin for profit, then I'm risking now 10%, a stock moving 10% in a shorter term trade, let's say a couple days, couple weeks, or months, that's a pretty big move for a stock to dip. Does it happen? It could, but it's better to, let somebody else take on the further risk in a shorter term trade and be able to lose a couple trades and still have the profitability of, 5 times out of your stop loss. So you can afford to lose. In fact, if you lose, that's totally okay, because you can lose, more than 50% and still come out profitable. So it's okay if you lose, if you have a less than a 50% win rate, actually, with this formula. So that's why I do it. Now, number 7, and this is one of the things that has allowed me to well, that was number 7, profit. And I meant to say number 2. So that was probability stacking. Number 2, and this is a huge one for me, and I think it is for a lot of investors, and I call this the G-Money method. And so basically, I used to play American football. And there was this guy on my team who was pretty small. He was always lean. He was kind of a smaller compact guy. But he could always hit really hard, and we called him G-Money. And he could always tackle people really hard. And it was always surprising how much of an impact he could make for how small he was, or how lean he was. And so I call this the G-Money method, because basically what this method is, the G here stands for Benjamin Graham. And Benjamin Graham was the was the mentor of Warren Buffett. Okay. And he is notorious. So this is for Graham. And he was notorious for looking for a market cap that was less than their total assets. So, in other words, there's a couple things. They're looking for kind of smaller companies. We're looking for big hitters with big hitter potential. And we're looking for these companies that they pack a punch, and they're, pound for pound or dollar for dollar, just valuable companies that we can trade and invest in. We'll kind of go into the balance of doing both. And essentially the G money method it is based on the principles of Benjamin Graham, in that the market cap of the company should be less than their total assets. So a really good example of some companies we've identified around like 80 cents a share. There's this one, it's called CTM. They signed a deal that was over $100 million, and their cash is around, $40 to $60 million, something like that. And their market cap was at like $75 million. So we were looking at their assets, we were looking at their income of what they're expected to make in their contracts, in much, much greater amounts than their market cap. So we found it to be a good investment. Now that investment has slowly built its market cap up to like $120 million or something like 120 million. And it's at, not 60, 70 cents. It's now at $1.15 a share. And so those are the types of movements. There's a lot of instances where the deals, another one like APLD, we're talking about that deal that you got. They're a data center builder for AI. And we'll kind of get into what allows us to identify those companies in a second. But what they do is they have like a $7 billion or $11 billion deal, and their market cap's only at 2 billion or 3 billion. Like, those are the types of opportunities that we oftentimes look for. So that's the G money method. It's the Benjamin Graham money method. You look for smaller big hitters that pack a punch and that have this is the most important, a market cap that is less than their total assets and deals they're securing, essentially. Because that's going to equal basically institutional attracting value. And that brings us to number 3. Now, number 3 is what I call the CRI index. Something I kind of made up. But basically the CRI, it is the company reliance index. So this is a method that I've developed over a couple years that I found has been really effective. This method is so effective that I've used it time and time again, and even if you don't realize it, you are probably using this method. And the method is that you're looking for a company that is the company that, if they didn't exist, the company that they provide to would have a 20% stall, or they would stop business if they didn't exist. So a really good example was like back in 2017, 2018, while a lot of people were looking at Tesla and everybody was looking at Tesla stock and Apple stock, which was not a bad investment. I mean, they've done really good. Um, I was asking what companies are out there that these magnificent seven are relying on in order to operate. And one of the companies, for example, would be like Nvidia. Like Nvidia for the Mag 7, if you would have looked at the research in 2019 to 2020 or even before that, you had Tesla relying on Nvidia for their self-driving cars and all their GPUs. You had Apple relying on Nvidia for the GPUs, the processors, for the iPhones and for the Apple tech. And so Nvidia was the main supplier. Now, if Nvidia goes out, they're off the table for Apple. They're off the table for, um, you know, Microsoft and data centers are they can't use Nvidia data centers or app like Tesla no longer can use Nvidia. Then those companies, the Magnificent Seven, would see a drawdown most likely of about 20%. So basically, if there is a reliance on a company and that company is irreplaceable, or if they didn't exist, then the bigger player would be at a huge disadvantage and would see a big drawdown in business, then that hidden player is going to be a good investment. You know, another good example, like Warren Buffett focuses on Coca-Cola, for example. Coca-Cola provides to major restaurants. So, like, let's say um, all the restaurants no longer, you know, offer Coca-Cola. What's going to happen? Like, they're probably going to see some sales dip. They almost every maybe I don't know if it's still like this, but there was a time where everybody wherever they go they'd order Coca-Cola. And what's going to happen? Pepsi's probably going to see more of a jump. Coca-Cola is going to lose some market share, or Pepsi is going to do better basically. And so you could look at different instances where, oh, if Nvidia didn't have Taiwan Semiconductor, they would be at a fault. They would be in a tough spot. So you're looking for companies. This is the CRI index, and how I determine it is basically their CRI index is correlated to how much of an impact that would have. It's kind of like a GDP. Like U.S. is confident putting tariffs on China because the GDP is, only, what is it, 3 to 5% or something like that impact on the US, which is still a big deal, but it's like we could afford to have a tariff and have negotiations happen, something like that. It's not ideal, but basically, what if we, that's why it's such a big deal with Mexico and Canada. We have massive imports on food and things from Mexico. It's like that could be a big impact on us. And so company reliance index is kind of a good indicator that I use oftentimes on determining if companies are in a good spot or not. Now, number 4 is what I call the clarity method. And the clarity method goes like this. The C is for consistent. So I'm looking for companies that have consistent financials, that have consistently good products, consistently are beating earnings, or consistently coming in with positive net income or positive good revenue. We're looking for consistency in their product, consistency in the market usage. So consistency is a big deal. The next thing we're looking for, if they don't have consistency, is going to be that they're a leader. Are they a leader in the market or potentially contending to be a leader in the market? And then for A, we do attractive as far as institutional attracting value. Are they attractive to institutions? Because sometimes companies, and this is what we'll kind of uncover in a minute here around buying the stocks, is they might look attractive to you, but if they could have all of the things lining up and they would not be an attractive company to institutions, the market won't move. So there's got to be things that line up, and that's why it's important to know what institutions really look for. Now, clarity, you got the R, and the R is going to mean the repeatable results. That the company is doing something that is repeatable and that they can continually bring in that revenue. So repeatable results. A good example would be we're seeing deployments of data centers, and every new data center that comes out, there's an added revenue of X amount. Or you see Coca-Cola, and they have this manufacturing that's like every single time they know they're going to get this much out. Now, I don't want to promote Coca-Cola. That's not what I'm doing. But, Apple, it's like repeatable results means like they know how many iPhones they could ship and everything else. So clarity comes down to repeatable results. The I, and this is what I always go off of, is going to be integrity. So maybe, investing in Coca-Cola could be potentially, what Warren Buffett invests in, but I wouldn't do it because I don't like the integrity of their product. There's a lot of sugar. It's been proven to negatively affect your health. I'm looking for companies that are having the integrity to improve humankind, and ultimately that's a predictive measure that would show long-term positive results. So integrity. And then the T is for that you notice that they are true to their word. So a good example, like there was a company a while back that, every week they said they had this new product. And then we looked at the products and they weren't actually getting released. They weren't actually getting bought by anybody. And they were, saying it's so exciting, such a good time. That's not being true to their word. And so you want to make sure the companies are delivering on time, or at least there's very, very reasonable reasons why they wouldn't be if they aren't, and everything else. Number 4 is going to be that you love the company. There's certain things that require conviction in the long term and short term and things like that. And you got to love the company. You got to like the company. You got to have the conviction for the company. And if you don't, then you're going to be weak to hold it, weak to buy it, easy to sell it, easy to turn it over if it goes down. And you want to invest in a company you love. That's really how I operate, and I found it to be very effective. And that's the cool thing, is there's so many companies you can choose. There are companies that you love that will be profitable and it'll be that much more satisfying when it happens. Now, number 5 is buy the stock. How many of you guys have heard buy the house or marry the house, date the rate? I say buy the stock and trade the dips or the drops. Buy the stock, trade the drops. Buy the stock, trade the drops. So this is where that 1 to 5 comes in. You might have a long-term hold that you're holding 1 to 3 years, 5 years, 10 years or more. But you can have that 1 to 5 ratio. 1 to 5 ratio for trading. This is where you can take advantage of opportunities that spike up in a few hours or a few weeks. Maybe they have higher volatility and you can take profits. These are volatile plays with volatility. And again, I usually trade for, it's a few hours. If the volatility spikes in our favor, we see a great move up and we can end up selling it. Awesome. But in the instance, it's like most trades, it might take some time to develop, some time to mature, or maybe even not be in the green. And so sometimes it could take, a couple weeks for a trade, or even sometimes over a couple weeks could be a couple months. Those are the time frames we work. Sometimes a few hours, sometimes a few minutes. Really just depends on how fast the stock moves. And that's where the 1-to-5 ratio comes in. So having a profit, meaning a take profit, a stop or a limit order that you would sell, and a stop loss that you'd sell, a stop order. So profit to risk. Now, buy the stock, trade the drops. What does that mean? It means you're buying the stock long term. You're holding the stock long term. This is how I do it, at least. And when the stock dips, I have trading positions that I enter. And these are where profits get taken. And these are where profits can be rolled out. If you're not at a point where you have, millions of dollars in your portfolio, or maybe you do, but you still want it to be bigger, it's not big enough that you would take a loan out against your stock, which is kind of the ultimate, tax advantage because you don't pay taxes on a loan. Then you're probably taking some profits out. And if you want to take profits, you want to have profits to take, this is where you look for what Warren Buffett calls, and this is kind of a short-term outlook that we do, but Warren Buffett says, buy when there's blood in the streets. When there's blood in the streets. So what that means is buy when the stocks are down. A lot of times, we get so excited when things are red, and people are like, Will, why are you so excited? And it's because that's when red usually equals a good entry. We're looking for that support buy. Do we buy the top sometimes? Yeah, I mean, I think if it's in the green, if it's up in the green, usually it does not equal a good entry if it's up at a resistance. However, what most people don't realize is that, a plan plus it being in the green will outweigh, that's going to equal, or even a plan plus red is going to equal a great entry. So you can buy the top, you can buy the support. You want to have everything line up. You want to have everything in your favor, whether it's, the probability stacking, the market, the usage, the financials, the balance sheet, the assets, the liabilities, the news, that stuff looks good. You want the charts in your favor. You want the trend, the support. You want to look for a support, buying at a support rather than buying at a resistance, of course. But, maybe they don't all line up perfect. Or if they do line up perfect, maybe they still don't go the direction you would expect. And that's where, you can buy. Ideally, buying in the red is going to be a better entry. And green is going to be not as good of an entry. But a plan plus buying in the green or at a resistance or when things are going good, or a plan plus buying at a support or when things are going bad for the company and they're down and out, equals a great entry because you have a plan. It equals a great entry because you have a plan for your entry and your exit. So that's the other key. Where you're going to buy, where you're going to sell, and that kind of goes back into the profit and the risk. Now, when we get into number 6, this is something that a lot of people don't realize, and this kind of ties into number 5, but use probabilities. Use probabilities to your favor. Okay? Use them to your favor, but realize this. Realize that probabilities, okay, so probabilities here. Probabilities are less than, or the old, like this is the key. The ultimate favor that you have, the ultimate advantage that you have, the ultimate favor. And I spelled that pretty bad, but hey, that's okay. is not the probabilities here, okay? The ultimate favor that you have will always be, it will be the preparation that you have plus the plan plus the action. So, in other words, things could be at an all-time high. They could be at the top. RSI is overextended. MACD is overextended. It's at a resistance. Everybody's saying it's at an all-time high. Things are up so much. They're not a good deal. Look how high they are. Sure, the probabilities might not be in my favor, but if I prepare, I set a plan, I have my margins for profit. I'm looking at the company. I have a clear margin that I would take profit and a clear margin I would cut losses. Or I have, if it's a long-term investment, I'm averaging in. I have preparation. I know what I'm doing, and I have a plan and action. It will always outweigh probabilities, always. So probabilities, you want to use them to your favor and get good at them because they ultimately will make you a great investor. But when it comes to like your ultimate favor and ultimate advantage, it will be your preparation, your plan, and the action in actually executing that plan. Strategy could, it's like the tale of the football teams that, beat other football teams because they have a better game plan. It's the tale of Elon Musk that says, yeah, everything was against me. It was very, very highly likely that I was going to fail in all of my companies, but I'm not going to look at the probabilities. I'm just going to prepare, plan on how I can make the most of this and then take massive action to make it happen. And the probabilities didn't matter. Same thing is true with Jeff Bezos. He's like, when he was pitching investors to get his first $1 million in seed funding, he said it was the hardest times in Amazon when he was trying to get his first $1 million for seed funding for Amazon. It was like, I don't know, 1994, something like that. I don't know what exact year it was. But he was saying the hardest part was getting that $1 million, and he told every investor, there's a 70% chance you don't get your money back. And he talked with 100 investors, something like that. Ended up 22 of them, something invested, I don't know, 50,000 each, something like that, and he ended up making $1 million. But and guess what? They made an insane return. But he told them 70% likely to fail. So probabilities are not going to be the thing that will determine your success as much as your preparation, your plan, and your action. For example, say the probabilities are super well in my favor. Everything's looking perfect. I get into a trade or an investment and it's not going the way that the probabilities would lead me to believe. Guess what? If you don't have a plan, you could lose big. So versus you could not have any of the probabilities, have a plan and set a stop or even take profit at a margin that makes sense for you. So that's why it's so important. Now, number 7 is the last and final thing. This is what I'll kind of leave you on. And this is the biggest thing I wish I knew when I was first investing. And it was, this is what holds you back. What holds you back? You might think it's because you don't know how to trade, or that you don't have the right skills, or that you're not getting the right information that you need. You need the information. You need more information. That you need to have a special strategy, which strategies help by all means. But what holds you back? It is not that you don't have the ability to do it. Now, there's certain instances, certain times, genes play a role. Sure, like people say they don't play a role in finance. They do. It's like, the basketball player, genes play a role. the tennis player, genes play a role. There is certain instances where the genes always matter, and it matters just for finance too. There are genes that you have for, your structure of your body, or your ability to, work and sit there and focus, or things like that. Some people get dropped on their head. They can't, I get it. But by and large, what holds you back is not your ability to be a successful investor or trader. It's going to be your decision. So it's not the ability, but it's the decision to become the person you want to become, to get the results you want. It's not that you can't, it's not that you don't have the ability. More by and large, I mean, unless you're looking for $1 billion or $500 million, there's a possibility that you don't have it in you. There is a possibility. Like, there's people that are wired a certain way. But when it comes to, $10 million portfolio, $20 million portfolio, increasing your active income, or starting a business, or running into these types of things where you can have the skills to increase your net worth, these types of things, you definitely, basically anybody has the ability to get to, million, 10 million, 100 million, even. That's a stretch, but that type of portfolio, those values are not out of reach for most people. Now, speaking of decisions, and this is the bonus number 8. This is speaking of decisions. If you want to learn exactly how to identify more great deals and execute your plans to trade stocks so you can build more freedom, grow your portfolio, be in the top 5% of investors, then I would encourage you to join Stockmate, or simply take a look. I recommend every investor that is either just getting started. If you're a beginner, there's great resources like our daily live trading sessions. But if you're an advanced investor and you're just looking to find the hottest markets, specifically in the industries of AI, in tech, in space, in quantum, or in defense companies, we release lists of the top companies in those industries, and I go live every morning at 6:30 a.m. Pacific Standard Time. You get to watch my entries, watch my exits. You get to see the investments we're watching, the different companies we're uncovering, and it's live every day at Market Open. So if you want to join us there, you can get it in the second link in the description. No, the first link in the description for Stockmates. And we got a flash sale there right now that's extended through the day. So you might as well get it, even if you don't hold AMD stock, which is one of the top competitors with NVIDIA, and they build the GPUs. They work with Microsoft. They work with they do the data centers. They even are providing the GPUs for the Starlink satellite internet. But I'm an investor in them. I got some call options. There's a flash sale extended through today that if you get into Stockmate and AMD stock hits $200 per share by August 20th, then you get Stockmate for free. Just a bonus there. You get a refund. You got that option. If AMD stock hits my targets and my call options go into the green there, going to make well in 5 figures, potentially more. And if that's the case, you get Stockmate for free. So that is the offer right now. And you also get a free t-shirt. So again, the first link in the description, go click it, simply take a look. Stockmate, if you want to join us there. The second link was for the full breakdown of this entire whiteboard. And then the first link is going to be Stockmate. You click the link, it'll take you to a page. You get your reminders, you enter your details. And you can join us in our market live session tomorrow morning. If you want to be there tomorrow morning at market open, it's there. And then the second link for this entire whiteboard, and then the third link in the description, and that's got the profit calculator. That's got the that 1 to 5 calculator for shorter term trades. So again, those are the 3 links. Simply take a look. I definitely encourage you, even if you're just a beginner or you're advanced, just take a look at that second or first link down below. And if I earned your thumbs up, hit that like button. Do consider subscribing, and I'll see you in the next video. Take care.